Well, we're back with another edition of the TradersCircle Podcast. Once again, I'm joined by Michael Cornums.
Good to see you, Sam.
Yeah, it's good to be back. And we've got a bit of ground to cover. It's been a couple of weeks and a lot has happened.
Yeah.
We've had a trade war. We've had a trade truce, perhaps. We'll know the details maybe in the next 24 hours, whether or not it is a truce or whether it's just a bit of talking, a bit of gamesmanship, perhaps, from the Americans. But I really think that Trump backed himself into a corner, and he's kind of had to come out and pretty much accept whatever he was given and back down as a result.
I think it's very confusing for everybody, including Trump. I think he's into announcing announcements. People are very wary of anything that comes out. This morning, we kicked off with a nice 60-point gain on our market, but that slowly slipped away during the day for, I think, the usual anxiety and just don't believe what they're telling you.
Yeah, no, absolutely. Our market ended up finishing flat. We had no gain despite, the weekend of supposedly positive news. I do want to sort of point out that it was the material stocks that did most of the lifting today. A strong session from BHP and Rio and the oil stocks and some of the smaller ones as well. And also, I think, it could have been a little bit of rotation out of the banks into those material stocks.
Do you think in the big picture, even with all the angst coming from the Trump administration, do you think we're moving away from that bearishness into a more hopeful zone?
I think we've been, I think the current bullish market begun in October 2023, and I think that we're still in that mindset. We're still in that market. And that was driven by hopes of rate cuts. Rate cuts here in Australia, at least, are still on the table. And in the US, I think they're still expecting about 2 more cuts this year. But I do think there's that bullish mindset, that bullish momentum still in play. And I think a part of that is not so much concern or belief in Trump, but it's a bunch of people who've seen any negativity be brought back up for the past 2 years, and they're just assuming that's going to continue to be the case. I think it's complacency more than anything.
Yeah, and I think overall, I think we were at a good level. I mean, we got up to 8,600, we got down to 7,100, good 1,500.4, and here we are back up to that 8,200 level. It's not a bad effort. No,
it's a huge rebound, huge rebound, and pretty sort of monumental. I mean, in the US, they had a consecutive run of gains that hasn't been seen for 20 years, in a supposedly negative environment. I do think it's more bullish complacency than anything. I think there'll be an awakening at some point, but I don't know if we're there yet, I do think in many ways it might be if inflation starts rebounding or if US debt starts spiraling out of control, if there's a situation that the Fed can't backstop the market, that's where I think the issues will arise.
But I think, as in the past, the Fed does do a good job of backstopping the market. With liquidities, you go back to the GFC or you go to COVID, the Fed comes in with unlimited amounts of liquidity, make sure those treasuries can be dealt around the world. So I think there's a lot of capacity there. I think Trump's trying to change things, but the underlying story probably doesn't, how far he gets with all those tariffs. Is it all just bluster and we'll just go back to an equilibrium?
I just want to comment on that. I don't think, he had all these big, ambitions when he started the trade war. And I think that we'll either see a huge economic crash or we'll see the trade war end without any of those ambitions achieved.
Yeah. It's a bit like the Doge. Initially they were talking 2 trillion savings, and I think that's gone out with a whimper. We don't hear too much of Elon Musk anymore. He's too worried about his car sales going down the drain. The savings are 2 trillion now. They're talking 150 billion. So is a tariff the same story? Will it just die with a whimper? Not too sure. The impression you get is that China doesn't seem too concerned about the American position.
No, and they're not beholden to the same news cycle as the US, the same public opinion cycle. Xi Jinping isn't going to have midterms in a couple of years.
Or a couple of decades.
Yeah. So it's not, America has to manage public opinion and their own populace, whereas China can really sort of...
Let's get on with the business of doing business.
Yeah, exactly. Yeah, so Trump's under a lot more pressure than China to make a deal, even if as much damage is being caused on both sides.
I think it's obvious to me, I follow a little bit of social media. I see the social media wave come in, pro-Trump. The weekend was anti-China. The Chinese are scared. I think we're a lot more sensitive to the bullshit we hear on social media, and I think people have got a big filter on that. The caution is, if you listen too much to the fake news, you're going to take a misstep on your trading. So I think you've got to put a very big filter on everything.
Oh, absolutely. And I think it's worth, keeping in mind that the articles are printed after the news happened, usually after the move has happened. The markets are moving hour by hour now. It's not in the past where you'd read an article and that would be the market's movement for the next week. You read an article, that was the last night's move, and then something else is going to happen today.
And today being that typical example.
Yeah, exactly.
Like the overseas markets, what were they up in the futures? 1%, 1.5%?
Yeah, perhaps even a little bit more in places. But the S&P 500, I think, up about 80 points, 1.25%, something like that. 1.25%. So that was the move when we opened this morning. I'd be surprised if they do much more when they close tonight.
And having traded Northern Star a few times last week, the message to me is take a profit.
Yeah. Oh, absolutely. We did a Northern Star trade. We traded it in advance of an expected move in gold. Mm-hmm. Gold moved, and we had a bit of a move in our favor in Northern Star. We closed out, but it started pulling back even in advance of gold pulling back.
Exactly right. And then after that trade, I went into it again and got out for the profit. And then as the gold came down, Northern Star kept going up. So you can't tell. And today, I think it fell a couple of percent.
Yeah, absolutely. And I think, sort of as we say, the last 2 years in markets have been pretty crazy. And this big sell down has obviously been bought straight back up, but I do think we're coming to a point where there's a break, things. It'll probably happen with the big crash. Things change essentially, not necessarily return to normal, but things change in the way they behave.
I think the great unloved I've seen over recent months are the small caps. That they've been the perennial cap raisers in the small cap sector. And I think the mum and dad market just aren't believing those small cap stories anymore. No. So I think it's a lot harder to raise capital.
Absolutely, and I think it also sort of points to this market. The mindset of the investor in this market is we're going to buy something now and take a profit in a month.
Yes.
If you speak to even the most bullish investors out there, they don't hold that much optimism for 5, 10, 15 years' time. And so, why would they invest in a small cap with a 10-year investment plan when they could buy CBA at 160 and sell it at 165? So
by definition, small caps is a long duration play. It is, in theory, a 10 or 20-year play. But as you say, people have gone to short-termism. The great strategy over the last 30, 40 years has been the 60-40 portfolio, 60% equities, 40% fixed income. We're seeing that in line with what you've just said, that disintegrating, because the baby boom generation, which has captured the great wealth in the world, are retiring. And there is a fear when you have the market go from 8,600 to 7,100 and you're all equities, you fear in retirement there might not be enough to survive on. So what the asset allocators are saying nowadays is, well, instead of 60-40 equities bonds, it's probably 60 bonds now, 40 equity, if less on the equity. People just can't take that volatility or the fear of that big crash that may come along.
Yeah, absolutely. And, at the moment, you're getting a reasonable return on fixed interest.
Yeah.
And the expected return on shares isn't particularly. There's not much equity risk premium, let's put it that way, because valuations are very, very high.
Yeah. And the other thing we've touched on in the last few weeks is the booming private credit market. And I had a financial guy, credit guy, call me today, and it is just booming out there in the credit market. The Australian banks are not big lenders, as big lenders to business as you would expect, whereas 30 years ago it was 80% lending to business. Nowadays it's 80% lending to houses. Australian banks are good at lending on housing. Australian banks are not that good at business, NAB probably being one of the better business banks. So that credit market is moving to the private sector, and there is money coming in droves.
Yeah.
And so many products coming out there. Absolutely.
And I think one thing we've touched on perhaps in prior episodes is the banks are basically reducing the amount of collateral they're holding against their loan books, sort of trying to leverage up their loan books and achieve a greater return on those loan books. When doing those sort of business loans or the private credit style loans,
too much capital.
They have to hold much more capital, and suddenly the return numbers possibly don't look as good, or the risk numbers look a little bit stronger.
Yeah. The banking system works under a total exposure risk limit of 5%. You often hear that there's capital of 12% or 14%, but that's after they drop the value of the asset loans. If it's a home loan, they drop it by the asset value by 30%. They weight the assets. But commercial loans are weighted at 100%. But the absolute risk exposure for a long time has been 5%. Now, APRA has given permission for the banks to go to 3.5%. So on a 100 million asset portfolio, they only have to have $3.5 million capital. And to get to that number, the safest way to do it, I think, is home loan lending. Yep. And not pick up those higher weightings from the commercial sector.
Yeah, no, absolutely. And I think at some point we'll probably do a video specifically on the bank riskiness, because it is something that's sort of snuck under the radar, I feel, of this market.
Yeah, each one of the banks have to report their credit risk exposure report that comes out. And it's interesting reading it. As you say, let's do a podcast on it one day.
Absolutely. But even so, even with the sort of lower capital levels, the banks look quite expensive. The returns don't look great. It's been 3 years of flat earnings, and the share prices have just skyrocketed over that time. I think that's going to be a bit of an anchor on our market to go too much higher in the sort of near-term future. Because there just isn't the growth there.
Well, the big positive for the Australian market is our superannuation system, which I think is about 3.6 trillion at the moment, and we have this great wash of cash. So the salaries of Australia, 12% of it goes into superannuation. So it's a growing pool of money. And just a little interesting fact, small business like ours, we pay our superannuation after the end of every 3 months, but that's changing on the 1st of July. Is that when the day you get your paycheck or paid into your bank account, we also have to pay our superannuation fortnightly. So the money going into the superannuation system will be going in on a fortnightly basis rather than the big lump sums, which in a small way is just more flow into the system.
Yeah, absolutely. And I think probably, a good change, because a lot of businesses in the past have sort of skipped out on the super, and it becomes perhaps more noticeable if it's more frequent.
And I think that's a big thing, and especially in the construction industry where we talk to...
Or hospitality.
A lot of the construction and hospitality... 80,000 bankruptcies in construction. They set up a shell company, they incur all the liabilities, and they walk away from the superannuation, they walk away from their insurances, walk away from everything and their tax. The good thing is the tax office is talking about making the directors more personal liability rather than trying to walk away. But it's unfair of the people who do pay all the taxes on time.
Yeah, positive change. Bringing it back to our market, like I said, I think there will be a bit of a difficulty, I would say, in adding too much capitalization to our market. The banks are priced to perfection in, an environment where they're not growing earnings. The miners are constantly sort of underselling pressure, but they do look fairly cheap. And outside of that, we don't have a whole lot of large companies contributing to the index level. If we were to pick one sector, I still think the mining sector looks the best value.
I think so. I think as America struggles through its redefinition of how unfairly the world's treating them, I think the Chinese, Russia, India, that brick block is going forward. As America complains, China's building train lines from St. Petersburg down to the southern coast of Iran. Belt and Road initiatives, they keep building and they keep putting infrastructure in, and they're concerned about world trade. America's worried about, everybody's doing them a bad deal because they're in a deficit, and their deficits they have to pay for with US Treasuries. But I think there is that other side where trade is being encouraged. It's good for Australia. China stopped buying some beef from the US. I was talking to some farmer friends over the weekend. There's a lot of demand coming in from China. Mm-hmm. The beef is getting more expensive. You may have noticed at the supermarkets. I certainly have. Some places over $100 for the meat. So I mean, there is a good story for Australia because we don't have tariff walls.
No,
and we are a free trade nation.
We are, and we've got a lot of resources that some of those Southeast Asian nations don't have as much access to. We've got a lot of land. We've got a lot of minerals.
Yeah. And I think it's very much in demand as the Chinese sector is buying up a lot of our farms, a lot of our natural food supplies. Mm-hmm. I think probably the issue, maybe giving a short-term direction, we've got CPI numbers coming out, inflation numbers coming out this week. We've got unemployment for us coming out this week. We're certainly looking to trigger we're very hopeful of lower interest rates for the year. That'll really, I think, in the end, be dependent on the unemployment rate. Yeah,
I think so. But, I don't think there's going to be many impediments to further rate cuts from here. I think even if there is pretty strong employment numbers, I think they'll still look to cut rates. Inflation's coming down. It was a little bit higher than expected last month, but kept falling. All signs are that it will keep falling. If the trade war lifts prices in the US, it might actually decrease prices here.
That's the point. So I think in a way we can look at Australia a little bit differently to the US. I mean, Powell was a bit more, a bit more hawkish last week. I thought.
He was, yeah. And the market sort of paid attention for all of a couple of hours, but. In the US, if they do have this trade war, there's a real risk of stagflation. The tariffs push prices up, but also economic activity goes down. And so the Fed's sort of, trying to spin their neck and pick which way to go. Do they support the economy or do they try and, keep prices under control? And I think there's a real risk that this is what I was sort of alluding to earlier, that they don't see the rate cuts in the US. And God forbid they see a rate rise because... I think that'd be a game over for this 2-year bull market.
Yeah, I think America is really on the cusp now. It's going, as any empire does, it does go through a change. The US, they'll be up to $38 trillion in debt fairly soon. It's not going down. There's a lot of rhetoric, but I don't think Doge is not working. The tariffs, well, good luck with that. So America is in a spot of bother, and I think the noise and the disorganisation, I don't know where the coherence is going to come from.
No, I think it'd be a difficult problem to solve with, a bunch of super geniuses trying to sort of formulate policy, and instead I think we've got sort of off-the-cuff, willy-nilly policy, or at least that's the way it seems. And I do think the US debt problem will spiral out of control. I think it's almost getting there already.
Well, and the political discourse is fairly fragmented. I mean, you got the Democrats against Trump, and you got 80% of Republicans against Trump.
Mm-hmm.
So something magic needs, but I just can't see where the good news is going to come from.
No, neither can I.
And if you stick China at 50% tariffs, 125% tariffs, well, it's just trade's just going to stop.
Absolutely. So this was the first weekend where ships arriving are paying the full tariff amount, and many of these, many of the largest ports in the US now have no ships arriving from China.
And hearing a lot of stories for the people who import, and that's a lot of people with their social media storefronts, reselling Amazon or whatever. You've got to sit there as an American importer going, well, will I pay the extra 100%? So what you naturally do, if you're managing your stock levels, is, well, let's pull back on that order. And the typical comment is, instead of buying our usual 100% of the order, we'll buy 30% and see how we go. Your problem's going to be if you do your full order book and pay your full tariff, and then Trumpy changes his mind in a couple of months, you're left with this overpriced stock. Yep. So you're damned if you do and damned if you don't.
Yeah.
It's just too hard.
It is. And that's why I think, there's a chance we see something break. Who knows? Maybe he'll unwind it from here, and it'll be only a small breakage. But
I think I am a little bit more bullish for Australia because our dollar has gone up.
Yep.
Which is
and that does give the RBA a bit more room to move.
And that's cheaper imports for us, which is really good. And with the excess supply that America doesn't want to buy, or that people don't want to buy it, that comes through Australia. So that's possibly cheaper prices for us.
Yep.
And I think that the demand for our raw materials, I think that's also very healthy.
Yep.
With China as well.
Absolutely. And just on the raw materials, I think we're going to see a huge shortage of copper in the next sort of 5 years, and moving beyond that as well. And so any copper miners in Australia, even if they're a bit expensive like Sandfire, I think will be good value moving forward.
You'd have to say that you've been calling copper up for a long time.
Yes, and it's been, it hit a high during a trade war, and I think it's only going to keep going up from there.
Okay. Yeah, and I think everybody is in agreement with that. In this world of everything needs. Where are you going to go in a world that has a weak America, and you're thinking about, well, what's secure? Well, it's going to be gold. It's going to be resources. It can be the cryptos. People have to diversify their portfolios, and you'd rather go into the harder commodities than into a US Treasury bond.
Yeah, absolutely. Especially with the debt issues in the US government.
Well, the thing is, the biggest mistake I think the US made on the debt issues is when Russia's treasuries, albeit that they felt they had good cause to take Russia's $400 billion off them, they broke the covenant. They said, we don't know, we're taking $400 billion off you. So every other small country who has over the decades incurred the anger of US now feel that they may lose their US Treasury.
Absolutely.
And
I think that's what kicked it off on gold. Obviously, it had been rising a bit already, but if you're one of these, if you're outside the in-group, one of these countries, and you're holding a bunch of US Treasuries, suddenly you might look for other central bank reserves.
So if you're Iran or one of the South American countries, you wouldn't be holding US dollars.
No. When you could hold gold, and they can't take that off you.
And what the interesting thing is, I think with Russia, they were holding it via European bank custodian system. So even if you're holding it third hand, I don't think it does you a lot of good. But the reserve banks around the world have been stockpiling gold. The people who don't stockpile gold are the Commonwealth countries, UK, Australia, Canada, and even America, don't pay much attention to gold, although America obviously has some gold. So, but the other countries, the BRIC countries, have certainly been stockpiling.
Absolutely, it's hard to see gold doing anything but keep rising.
Interesting, we've had a pullback on gold. It got to the boom 3,500. I think I saw 3,250.
It's come back. It's come back.
As Bitcoin's gone over 100,000. Interesting dichotomy.
And I think it's like I said, it's hard to see gold doing anything but continue to rise as it has done for the last 50 years.
A few governments are talking about crypto reserves. That language is getting a lot stronger. I think there is also support in the US for crypto legislation. Talking to friends, I think there's a lot of interest in the DeFi type contracts, decentralized financial contracts. So use cases for crypto.
Yep.
So I think we're going to hear a lot more of that over the next 6 months.
I think fair chance, and I think we'll see central bank digital currencies. I mean, with the digital reserve, the crypto reserves, it sort of begs the question: what will be in the reserve? But yeah, I struggle to be as positive on it as I once was, and I think that especially in the decentralized space, it's become less decentralized over time. Initially, that was what it was all about, really. And nowadays, the big projects, the biggest coins, the biggest tokens, tend not to be decentralized. And people applaud the lack of centralization, and they ask for more government interference.
It's about the ability. There is a benefit to financial contracts on the blockchain as opposed to going through all these custodians and the paperwork. And it's interesting, coins like XRP, going from 50 cents at Christmas to got to $3.
Mm-hmm.
So there seems to be a lot of interest out there.
Yeah, absolutely. And I think as more infrastructure is built for it, those things will become more appealing. But they rely on the real world infrastructure underneath it. Asset transaction systems and things for real world assets.
So in terms of trading, what any particular shares you're looking at, Sam?
I think that if there is some sort of wind down of the trade war, the most attractive part of the market looks to be the resources space. You've heard my views on copper and I guess on gold. But just in general, the large miners look fairly attractively priced, especially compared to the market average prices. Outside of that, it's a bit hard to have too strong an opinion because everything else seems priced to perfection. And if there is a bit of a break in this 2-year bull market, I think it's those other things that are going to suffer.
Yeah, like in the tech sector, you're seeing China making some headroads against Taiwan and the Netherlands chip manufacturers. So China is moving to that, and as you say, the big 7 in the US is priced to perfection. Things can only go wrong with it.
Yep.
Apple's got the question mark of manufacturing in China being a big stock. The financials, again, as you say, the price to perfections. You're not going to get Commonwealth Bank doubling from this level. You wouldn't think.
No, you wouldn't think. I mean,
we're cautious.
Cautious. You wouldn't have thought so at $90, but.
And I think I saw consumer discretionary JB Hi-Fi take a tumble the other day.
Yeah, that's a crazy one because JB Hi-Fi was I think posting better results when it was $40 a share and the market didn't want to touch it. It runs north of $100 on. I don't think as stronger numbers, but
I think it just goes almost into a network effect where it's just successful, and everybody just go, well, you can't lose.
Yeah, exactly.
Pick it up as a liquidity stock.
Exactly,
and you can't get enough of it.
And that's a symptom of this sort of momentum-driven market. And to me, it just screams that there will be something that breaks before too long, and a bunch of the people in the market that we see or that we read about or that we've sort of seen post online or things like that, they assume that the conditions the last 2 years are going to be the conditions forever from this point onwards. And
well, I think that is probably the biggest thing I see from our clients is they believe what's happened in the last 30 years, house prices are going to double every 10 years. The Federal Reserve will always save the economy. And any dip needs to be bought, and then and we haven't really had a recession since the late 80s. So it's time.
Yeah.
So it does seem like time to be cautious.
Yep.
If you trade, be quick to take a profit.
Yep. Quicken it out.
Quicker to take
And there
a
are
loss.
large, quick movements. It's the perfect market conditions for sort of short-term trading. You can get a 1-2% move and then 1-2% move back the next day, and it is that sort of market.
That's right. And using the mini warrants as we do here, we get that 3-4 times leverage, quick move, quick profits, and also quick losses, but take your losses sooner.
Yep, absolutely.
All right.
Well, we'll wrap it up there. Hopefully you guys enjoyed watching this video. If you've made it this far, please click like and subscribe. Maybe suggest a video topic in the comments below if you're here as well. And we'll hopefully see you guys in the next video.
Cheers.